Okay, so one housekeeping item before we move forward. In the previous video, I forgot to update the file name to Statement of Cash Flows Part 2. So hopefully you did that, but if not, no worries at all. You can use whatever naming convention is most comfortable to you. So now we've finished the cash flow statement and we're ready to start forecasting the income statement. So I'm just going to quickly clean up all the highlighted cells that we use when we build our cash flow statement using Control-Shift-N. And as you recall, the purpose of this exercise is we now have to project out into the future what we think the company is going to do now that we have a decent grasp on the historical financials. And then right before we get started, well, something happens. We get an email from our managing partner, and it says, he sent me their adjustments, see attached. So what is he talking about here? He's actually talking about EBITDA, which is something we haven't touched on yet. EBITDA is a financial metric that private equity firms use to benchmark their valuation to see if they're paying a fair price. So before we get into the modeling piece, I want to quickly go over what EBITDA is and why it's used. So what is EBITDA? If you're familiar with the term, it's the earnings before interest, taxes, depreciation, and amortization. And it's used because it serves as a general proxy for the pre-tax operational cash flow. So what does that really mean? Well, when a private equity purchases a business, it typically does it based on a purchase multiple of the free cash flow. However, the free cash flow isn't always readily available because not every company has a fully functional financial model in the way that we're going to be building here. So we use EBITDA instead, which is a proxy for what the free cash flow might be. So if you think about it, the financials as shown are on an accrual basis. And so if we take out everything that is non-cash, such as the depreciation and the amortization, we should get a good sense of what the true cash earnings would be. In addition, the interest is only indicative of the current financing structure, but isn't indicative of a permanent financing structure. As an example, a buyer could come in and pay all cash, and therefore there wouldn't be an interest component to the expenses. And taxes, which can vary pretty materially year over year depending on how the company performed in a prior year. So we always want to strip that out because it helps normalize the cash flow. So once we've taken out all of these things that are subject to change or either non-cash, we have a general estimate or proxy of what the free cash flow might be. Something extremely important to note is that EBITDA is not recognized by GAAP. So it's a financial metric that companies are able to compile, and it's a great way to help normalize businesses for purposes of comparison, but it is not recognized by GAAP. And that plays into our next level of EBITDA. So there's also management adjusted EBITDA, and this is what the managing partner was referring to when he sent us that email. So what is management adjusted EBITDA? Well, let's define it first. It's EBITDA from above plus or minus any non-recurring income or expenses management feels should be added back or taken out to get a better sense of the normalized financials. So let's just talk about what this means in simple terms. Think about your family's budget. If normally every month you save $500, but then in the month of December, you bought a very expensive TV and you spent an extra $1,000 so that month you lost $500, you might say for your family budget next year, you know what, we would have saved $500, but we spent $1,000 on that TV, so we should add back the $1,000 of cost to get a better sense of what we save on a normalized basis. So that's exactly what the management team is doing here. They've gotten help from the investment bank to define their EBITDA. And then what they want to do next is go through and make specific management adjustments for things that are non-recurring. So that might be legal fees on a one-time basis, or if they charged a consultant for specific services that won't be charged again, or they hired an employee on a temporary basis that they won't be hiring in the future. All of those things in management's eyes are non-recurring, and therefore they should be added back to the expenses to get a better sense of what the earnings would have been on a normalized basis. So let's use an example. Let's say they had to spend $100,000 on legal fees for something in the past, and that what that would do is that would hurt their EBITDA as defined by $100,000. But they would say, well, look, that was a one-time thing. It's not going to happen again. So we need to add it back so that you, the buyer, know on a normalized basis that that $100,000 wouldn't always be there. The third layer or tier of EBITDA is what I like to call diligence adjusted EBITDA. And diligence adjusted EBITDA is the management adjusted EBITDA, so from up here, plus specific costs the private equity firm will incur as part of the transaction, such as diligence and closing fees, annual management fees, and normalized income or expenses. So sometimes this will be also the private equity firm pushing back on some of the management adjustments. So as an example, let's say management hired what they considered a part-time person, but that part-time person worked for the company for 3 years, and they tried to add that salary back. The private equity firm might say, you know what, this person really seems to me like they're full-time. We're not going to give you credit for that add back, so we are going to net it out in our diligence adjusted section. And very frequently, if not often, for a buyout transaction, the private equity firm will hire an outside company to perform a quality of earnings, or what we call a Q of E, to independently validate these adjustments. So why do this? Well, an outside firm helps lend some credibility and independence between the two sets of adjustments so that everybody eventually can agree on what a normalized level of earnings is. And what the Q of E firm is going to do is they are going to put together a schedule that is laid out exactly like we have here. First, they're going to create EBITDA as defined. So they're going to look at the financials provided by the company and build it as earnings before interest, taxes, depreciation, and amortization. Second, they're going to look at the management adjusted EBITDA in its own schedule right below the defined EBITDA. And then third, they are going to create their diligence adjusted EBITDA that may or may not overlap with the internal analysis of the private equity firm. And this is going to be laid out in a long schedule that may have 20 or 30 rows. And so it's extremely helpful to your team and the Q of E firm for you to lay out your model in this exact fashion as well. Because as the Q of E changes, your model will change, and you want to be able to quickly add in the adjustments without creating too much confusion and always having a clear depiction of the schedule all the way down. Lastly, the diligence adjusted EBITDA may not even be the final tier of your EBITDA analysis. So as an example, you may have an additional schedule, and in this case I've cited a lender adjusted EBITDA because that occurred in a deal that I did in the past where the lender had its own adjustments that it wanted to see in addition to the management adjustments and the diligence adjustments for purposes of calculating its covenants. So what's the takeaway from all this and why lay it out in this way? So you can see, first off, the EBITDA schedule can get pretty complicated. So it makes a lot of sense for it to be laid out line by line in an organized schedule so that anybody opening your model knows exactly where they are in the EBITDA schedule and how to benchmark the valuation on that specific tier. And also, different people will want to refer to different EBITDA metrics depending on what they're solving for. So as an example, when you're reporting EBITDA to the fund, you will typically use the diligence adjusted EBITDA, but when you're preparing a monthly or quarterly schedule for the lender, you'll be using the lender adjusted EBITDA. And then in the future, when you go to exit the business, you, along with the management team, will create your own set of management adjustments, and that will be used for the prospective buyer. So having them tiered out avoids confusion and allows people to use the EBITDA schedules to meet their specific needs.